Garry Evans, Global Head of Equity Strategy at HSBC, joins me now. Welcome to you, Garry. Great to have you on the program. So you're still a big emerging markets man, even though we saw some weakness there in the first few weeks of the year with investors really switching from emerging to developing markets. You still think there's a way to go for emerging markets?
Yeah, so they've made up about half the underperformance they did in the 6 weeks. So I still think, at least for this year, the emerging markets look better. And I'll give you a couple of reasons for that. One is I think people are very underinvested in emerging markets. I mean, we all like them, but if you actually look at global funds, if they follow the usual benchmark, they should have 13.5% in emerging markets. Actually, they have 9.5%. So people like the story, but they haven't necessarily implemented it yet.
Now, you also think that inflation concerns are going to ease, which I'm kind of surprised by, because inflation in the emerging markets is really roaring ahead, isn't it?
Yeah, the thing is, we all know that, though, and markets are all about anticipating what's going to happen. You know, who doesn't know inflation is a risk in China and in Brazil? And what you have to remember is central banks there have raised rates very substantially already. Brazil 300 basis points, China 100 basis points. So I would say it's priced in, and the risk is rather more, you know, the ECB will raise further. Inflation expectations in the EU and in the US and the UK are rising quite sharply. So I think actually the shift of risk in inflation is going to DM and actually away from EM.
Interesting. Now, the headline of your second quarter report is that it's going to be a tricky few months ahead, perhaps time to take a bit of risk off the table.
Yeah.
Just explain that.
So we called it a wobble in an uptrend. I'm not looking for a new bear market, but there's lots of headwinds at the moment. The oil price is the obvious one. That's starting to affect consumer confidence. A bit less obviously, it's going to affect corporate margins. So I think corporate profits aren't going to be as good as people forecast.
So that's going to be the theme, because we've just kicked off earnings season.
Right.
And so we're going to be looking for companies, what they're saying about oil and commodity prices and the impact that's having on their margins. You think we're going to see those squeezed?
Exactly. So analysts are still forecasting that in the US in particular and in emerging markets that margins are going to expand this year. Having last year been pretty good, particularly in the US. And I think given the way raw materials prices have gone up, that's actually pretty hard to achieve. So I'd look for a bit of disappointment on the earnings side.
Now, when we talk about the oil price, I mean, the IMF has come out recently, so is the International Energy Agency, saying these are high prices and they're a risk to growth. The IMF pointing particularly to the US and Japan. But at what price does oil endanger the global recovery for you guys?
So the analysis that we did suggests it's not the absolute level of the oil price that matters, it's the year-on-year change. And I said the cutoff point was about 75% year-on-year. So in terms increase in the oil price, and that's about $130 to $135 a barrel. I mean, quite close earlier this week, got me nervous. But I think up to that level, we're probably okay. Above that, you'd have to fear a global recession and a bear market.
$130 a barrel.
Yeah.